It's wild. The decisions that are quietly destroying most people's financial lives aren't gambling addictions or exotic investment schemes or some obviously reckless behavior that everyone can see coming from a mile away. They're normal decisions. Completely, totally, socially acceptable normal decisions that every person around you is also making. Decisions that feel responsible, even mature. Decisions that get nodded at by parents, encouraged by friends, and basically treated as milestones of becoming a functioning adult. And that's exactly what makes them so dangerous. Because when something is normal, you don't question it. You don't run the math. You just do it because that's what people do. And then you spend the next decade wondering why you never seem to get ahead no matter how hard you work. I spend way too much time digging into the financial decisions that look fine on the surface but are quietly bleeding people dry underneath. If you want to actually understand where your money is going and why your net worth doesn't seem to be growing the way it should, make sure to subscribe and hit the like button if this video ends up shifting how you think about money. Today we're going through 7 of these decisions, and I promise you, at least 3 of them are things you're either doing right now or planning to do soon. Let's get into it. Decision 1: financing a new car and replacing it every few years. This is probably the single most normalized financial disaster in America. You graduate, get a job, and the first thing society tells you to do is get yourself a real car. Not that beater you drove in college. A new car. A car that shows you've arrived. So you walk into a dealership and you do what everyone does. You ask about the monthly payment, not the total price, not the interest rate, not what this thing is going to cost you over the life of the loan, just the monthly payment. And the dealer, who has been trained their entire career to sell you on monthly payments, tells you it's only $550 a month. And you think, okay, I can handle that. But here's what's actually happening underneath that number. You're buying a $35,000 asset that immediately loses 20% of its value the second you leave the lot. You haven't even gotten home yet, and you're already down $7,000. Then it keeps depreciating, losing another 10 to 15% every year after that. Meanwhile, you're paying interest on a loan for something that is actively becoming worth less every single day you own it. By the time your 5-year loan is done, you've paid close to $40,000 total for something now worth maybe $12,000. Now compare that to a 3-year-old reliable used car sitting at $15,000 to $18,000. You're still spending money. Nobody's pretending otherwise. But the gap between those two choices, roughly $20,000 to $22,000, that's the number that actually matters. Because that's real money that can either go to a dealership or go to work for you. $20,000 invested in a basic index fund at an average 8% annual return, left alone for 20 years, becomes roughly $93,000. No extra work, no special strategy, just the decision to not buy the more expensive car. And if you're the type of person who upgrades every 3 to 4 years, that number compounds even harder. Every single time you trade in for something newer, you're making that same choice again, handing over another $20,000 gap to a dealership instead of your future self. 4 or 5 of those decisions over 20 years and the cumulative difference can push past $300,000 to $400,000. Not because you did anything reckless, just because you kept choosing the more expensive option in a category most people never think twice about. The person in the used car isn't sacrificing their life. They're still getting to work, still running errands, still living completely normally. The only thing they gave up is the feeling of having something new. And they traded that feeling for somewhere between $93,000 and $400,000 in future wealth depending on how consistently they stick to the decision. That's not a sacrifice. That's the best trade in personal finance. Decision 2: buying the maximum house the bank will approve you for. Banks will approve you for a mortgage that will make your life genuinely miserable. That's not an opinion. That's just how their approval criteria works. When a lender tells you that you're approved for a $600,000 mortgage, what they're saying is, based on your income and debt, we're confident you won't immediately default. They're not saying you can afford it comfortably. They're not saying you'll be able to save for retirement while paying it. They're definitely not saying you'll be able to handle a major repair, a job loss, or any of the thousand other things that happen in real life. They're saying you won't immediately default. That's the bar. And yet people hear approved for $600,000 and they immediately start shopping at $600,000. Because why wouldn't you get the most house you can? Why settle for less if the bank says you can have more? Because the bank's risk tolerance is not your financial plan. Their job is to make money on your interest payments. Your job is to build actual wealth. Those are not the same goal. What actually happens when you max out your approval is that every single dollar of margin in your budget disappears. There's nothing left for investments. There's nothing left for emergencies. Your entire financial life becomes about making that mortgage payment. And when something inevitably goes wrong, and something always goes wrong, you're not just stressed, you're in crisis. The 28% rule exists for a reason. Your total housing cost should not exceed 28% of your gross monthly income. Not because some financial advisor made that number up, but because anything above that and you start making all your other financial decisions from a place of scarcity and desperation. Find the house that fits within that threshold. It will feel like less. It will probably be smaller or in a less exciting neighborhood or have a kitchen that doesn't look like something from a renovation show. But you'll be able to invest consistently, handle emergencies without going into debt, and actually build net worth instead of just owning a liability that consumes every dollar you make. Decision 3, not negotiating your starting salary. This one is so quiet and so devastating that most people don't even register it as a decision they made. They got an offer. They accepted it. That's just how hiring works. Right? Wrong. Roughly 70% of employers expect candidates to negotiate. Most initial offers are 10 to 20% below what the company is willing to pay. Most people never say a word because they're afraid of seeming greedy or having the offer pulled. So they take the first number, say thank you, and move on with their lives. Here's what that actually costs you. Let's say you're 24 years old and you accept a $55,000 salary when the company would have gone to $62,000. That's a $7,000 difference. Over the next 10 years, assuming you get standard 3% annual raises, that initial $7,000 gap compounds into roughly a $90,000 difference in cumulative earnings. That's before you factor in retirement contributions, because your 401k match is often calculated as a percentage of your base salary, which means a lower base means a lower employer match every single year. A simple 5-minute conversation asking for more money could be worth 6 figures over the arc of your career, and not just at your first job. Every time you change positions, every time you're up for a promotion, every single negotiation either builds on a strong foundation or compounds a weak one. The cost of not negotiating isn't just the money you didn't get. It's the entire financial trajectory you set yourself on. Because everything else in your financial life compounds from your base income. Decision for paying only the minimum on credit card debt. Credit card companies are counting on you to do this. They've built their entire business model around it, and it's working spectacularly. The average American household carrying credit card debt has a balance of around $6,000, at an average interest rate of somewhere between 20% and 27%. If you're making minimum payments on that balance, something like to 2-3% of what you owe. Here's what happens. You're paying around $120 to $180 per month. It feels manageable. It feels like you're handling it. But the majority of that payment is going toward interest, not principal. You're barely touching the actual debt. At minimum payments, it will take you somewhere between 15 and 20 years to pay off that $6,000. And the total amount you'll have paid by the end, including all that interest, will be somewhere around $12,000 to $15,000. You're paying double or more for things you bought years ago. That vacation from 2022 is still costing you money in 2026. That laptop you needed urgently is still draining your bank account. The thing is long gone. The payment never ends. And here's the part that really stings. While you're slowly paying interest to your credit card company every single month, you're not investing that money. So it's not just the interest you're losing, it's the compound growth you never got because those dollars went to a financial institution instead of an index fund. Pay off high interest debt aggressively, not minimums. aggressively. Throw every available dollar at it until it's gone, because no investment return is going to outperform the guaranteed 24% you're losing to interest every year. Decision 5: Lifestyle inflation after every raise. This one is so insidious because it feels completely earned. You worked hard. You got a raise. You deserve to upgrade your life a little. Better apartment. Nicer car. More dinners out. Better clothes. You've earned it. And then next year you get another raise. And you upgrade again. And the year after that, another raise. Another upgrade. By the time you're in your mid-30s, you're making 3 times what you made at 23. And you have almost nothing saved. Because every single dollar of income growth went straight into a corresponding increase in spending. Your lifestyle grew exactly as fast as your income, which means your financial position hasn't actually improved at all. You're just broke at a higher level. This is called lifestyle inflation. And it's the reason there are people making $150,000 a year who are genuinely stressed about money. The income grew. The expenses grew with it. The gap between income and spending, which is the only number that actually matters for building wealth, stayed roughly the same. The antidote is simple but psychologically brutal. Every time you get a raise, commit to saving and investing at least half of the increase before you spend a single dollar of it on lifestyle upgrades. If you get a $5,000 raise, put $2,500 toward investments first. Then, if you want to, use the other $2,500 to improve your daily life. This way your wealth grows with your income instead of just your spending. Decision 6: Pausing or delaying 401k contributions. People stop contributing to their retirement account all the time for reasons that feel completely logical in the moment. They need to save for a house. They have high interest debts. They got a new job and there's a waiting period. They want to see how the market does before they start putting money in. Every single one of these reasons costs money. Significant money. And here's why. The power of compound growth is front-loaded in time. The dollars you invest in your 20s are worth dramatically more than the dollars you invest in your 40s. Not because of anything you do, but because time is the most powerful variable in the compound interest equation. A 25-year-old who invests $5,000 and never contributes another dollar will have more money at 65 than a 35-year-old who invests $5,000 a year for 30 consecutive years. That sounds impossible, but it's just math. The early years have 40 years of compounding to work with. The later years of 30. That 10-year difference at the beginning is worth hundreds of thousands of dollars at the end. When you pause contributions for even 2 or 3 years, you're not just losing the returns on the money you didn't put in. You're losing the compounded growth that money would have generated over every remaining year of your working life. 2 years of missed contributions in your late 20s can easily translate to $100,000 or more in missing retirement savings by the time you're 65. Always contribute at least enough to get your full employer match. That match is an immediate 50 to 100% return on your money depending on your plan. There is no investment on earth that reliably delivers that. Passing it up is like turning down free money because you're busy. Decision 7: Co-signing a loan. This one is awkward to talk about because it always involves someone you love. A parent, a sibling, a close friend, someone who needs help and who you want to support. And co-signing feels like a low-stakes way to help. You're not giving them money. You're just lending them your credit. What's the harm? Here's the harm. When you co-sign a loan, you're legally, fully and completely responsible for that debt. Not sort of responsible. Not responsible if they stop paying. Responsible, period. If they miss a payment, it hits your credit immediately. If they default entirely, the lender comes directly to you for the full balance. And here's the part nobody thinks about when they're feeling generous in that moment. You have no control over whether they make the payments. None. You've taken on 100% of the liability and 0% of the control. People co-sign car loans and then discover 6 months later that the car was repossessed and they owe $18,000 to a lender for a vehicle they've never driven. People co-sign apartments and end up on the hook 4 months of unpaid rent from a friend they no longer speak to. People cos and student loans for children who dropped out of school and are now watching their retirement savings get garnished. And the damage extends beyond the direct financial hit. A co-signed debt shows up on your credit report as your own debt. It counts toward your debt-to-income ratio. It can prevent you from getting your own mortgage, your own car loan, your own apartment. The financial ripple effects of one cos gone wrong can set your personal wealth building back by years. If someone you love needs help and you want to help them financially, give them money directly if you can afford to. A gift, not a cos-in. Because with a gift, the worst case scenario is you're out the money you gave. With a cos-in, the worst case scenario is you're out money you didn't even have. Here's the thing about all 7 of these decisions. None of them are unusual. None of them are reckless in the way that people usually think about financial recklessness. They're just normal. And that's what makes them so costly. Because the financial decisions that hurt you the most aren't the obvious ones. You know not to blow your savings at a casino. You know not to invest your life savings in a single stock. The dangerous decisions are the ones that everyone around you is making. The ones that get described as just part of life. The ones that nobody questions because questioning them would feel weird or ungrateful or overly cautious. But here's what separates people who build real wealth from people who spend their entire lives wondering where their money went. It's not income. It's not luck. It's not some secret investing strategy. It's the willingness to actually look at these normal decisions with clear eyes and ask whether they make mathematical sense for your life. Most of the time they don't. And once you see that, you can't unsee it. You don't have to max out the mortgage. You don't have to take the first offer. You don't have to keep co-signing because you feel obligated. You get to look at these things honestly and choose differently. Every time you choose differently, you're not being cheap or antisocial or weird. You're just playing a different game. A longer game. A quieter game. But one that, a decade from now, you're going to be very glad you played.